Hello, everybody. In this opportunity, we are talking about personal finance. Personal finance is a term that covers managing your money as well as saving and investing. It encompasses budgeting, banking, insurance, investment, retirement, etc. The term often refers to the entire industry that provides financial services to individuals and households and advises them about financial and investment opportunities. Individual goals and desires and a plan to fulfill those needs within your financial constraints also impact how you approach the above items. To make the most of your income and savings, it's essential to become financially savvy. It will help you distinguish between good and bad advice and make intelligent financial decisions. Personal finance is about meeting your personal financial goals. These goals could be anything: having enough for short term financial needs, planning for retirement, or saving for your child's college education. It depends on your income, spending, saving, investing, and personal protection. And then we move to areas of personal finance. The first about income. Income refers to a source of cash inflow that an individual received and then uses to support themselves and their family. It is the starting point for our financial planning process. Common sources of income are salaries, dividends, and then bonuses, pensions, or hourly wages. The sources of income all generate cash that an individual can use to either spend, save, or invest. In this sense, income can be thought of as the first step in our personal finance roadmap. And then the second about protection. Personal protection refers to a wide range of products that can be used to guard against an unforeseen and adverse event. Common protection products include life insurance, estate planning, health insurance, etc. This is another area of personal finance where people typically seek professional advice and which can become quite complicated. There is a whole series of analysis that needs to be done to properly assess an individual's insurance and estate planning needs. And then the third about spending. Spending includes all types of expenses an individual incurs related to buying goods and services or anything that is consumable. All spending falls into two categories: cash and credit. The majority of most people's income is allocated to spending, and common sources of spending are rent, credit card payments, taxes, travel, food, entertainment, etc. The expenses listed above all reduce the amount of cash an individual has available for saving and investing. If expenses are greater than income, the individual has a deficit. Managing expenses is just as important as generating income. And typically, people have more control over their income. Good spending habits are critical for good personal finance management. And then the fourth about investing. Investing relates to the purchase of assets that are expected to generate a rate of return with the hope that over time the individual will receive back more money than they originally invested. Investing carries risks, and not all assets actually end up producing a positive rate of return. This is where we see the relationship between risk and return. Common forms of investing include stocks, commodities, art, bonds, private companies, mutual funds, real estate, etc. Investing is the most complicated area of personal finance and is one of the areas where people get the most professional advice. There are vast differences in risk and reward between different investments, and most people seek help with this area of their financial plan. And the fifth about saving. Saving refers to excess cash that is retained for future investing or spending. If there is a surplus between what a person owns as income and what they spend, the difference can be directed towards saving or investment. Managing savings is a critical area of personal finance. Common forms of savings include physical cash, money market securities, savings bank account, checking bank account, etc. Most people keep at least some savings to manage their cash flow and the short term difference between their income and expenses. Having too much savings, however, can actually be viewed as a bad thing since it earns little to no return compared to investment. I think it is enough for this session, and thanks for watching. Don't forget, give this channel with your like, comment, subscribe, and don't forget share. Thank you.